Hey everyone, Kieran King here. Now, if you live in the UK or follow UK business and finance, in recent news you may have come across the word gilt or gilt edge securities. Now, if you have no idea what gilts are, then this video will be for you. So let's get going. A gilt, in simple terms, is a bond or I.O.U. issued to investors by the Debt Management Office or DMO, which is an executive agency of HM Treasury, which in turn forms part of the UK government. So what is a bond or I.O.U, you ask? Let's quickly explain what it is, using an example here. So a bond is essentially an I.O.U document between a lender and a borrower. An organization, company or government will go out to investors and say, right, we want to raise money for new projects. They will then issue bonds to those investors in exchange for their cash. So for example, let's say you as an investor buys a bond from a company or government, in this case, for £1,000. Meaning that you have loaned the government £1,000 and in return have received this bond. Of course, money isn't free. So let's say that this particular £1,000 bond has an interest rate or coupon rate of 5% with a maturity of 10 years. This means every year for 10 years you will receive 5% interest of the money that you put down, which is £50 a year. And after the 10 years is up, the company then owes you the principal or original £1,000 you put down. So in total, you will have received your original £1,000 plus the interest payments each year for 10 years of £50 a year, which is £500. So in total, you would have had a return of £1,500 for the £1,000 that you put in after 10 years. So going back to gilts, a gilt is simply the name given to a bond issued by the UK government, like the case that we've just gone through, as opposed to being issued by a company or another entity. They are called gilts, as in the past the original certificates that were issued to investors had gilded edges, hence why its full name is Gilt Edge Securities. And gilded, all that means is that it was covered in gold or had a golden colour. So you can imagine that the monies raised from issuing gilts to investors is for public spending. Now, they have a maturity of anything from a few months to over 50 years and can offer a coupon rate of up to about 6%. In addition, they also pay out interest to investors twice a year. These special bonds are also traded on the London Stock Exchange, and their price people trade them at change in line with supply and demand factors. Now, there are two types of gilt categories: conventional and index-linked gilts. Conventional gilts are just as we have discussed. They have a fixed coupon and maturity and are written something like 2% Treasury Gilt 2030. Meaning that it gives a 2% coupon a year and matures in 2030. Now, if you see gilts being traded on the London Stock Exchange, you will see here that there are lots of varying gilts that are traded. This is because each one reflects the coupon rate it had when it was first issued. So with conventional gilts, you need to know that it has a fixed coupon and maturity. Now these type of gilts make up around 75% of gilts in the UK. The other 25% are known as index-linked gilts, and this means that the coupon rate given constantly changes in line with RPI or retail price index, which is a measure of inflation. Why is it index-linked? Well, in theory, they were brought in so that the gilt's real value doesn't diminish due to market forces such as inflation. For example, if inflation is at 2% and the coupon of a conventional gilt is 4%, if inflation rises to about 4%, then the gilt will essentially be giving out a lesser attractive real-life return and investors will go elsewhere. However, with index-linked gilts, they will take the rise in inflation into consideration and the coupon rate will change accordingly. I hope that makes sense. So we've looked at what a gilt is, the difference between conventional and index-linked gilts, and that they are traded on the London Stock Exchange. But what factors affect a gilt's price? Well, one of the main factors is faith in the UK's government ability to pay back the coupon and principal on the issued gilts. So far, they have never missed a payment to investors and it is seen as a relatively safe investment. However, of course, if people start to lose faith in the government and think the government might go bankrupt in the future, then the gilts will lose their value. Somewhat related to this is the level of interest rates. If interest rates go up, it's mainly then that gilt prices fall and vice versa. And this is linked to inflation. So if inflation goes up, what happens usually is that governments tend to increase interest rates, which you can check out in a separate video I did here. And an increase in interest rates means a decrease in gilt prices. This is because investors can find a better return elsewhere than in buying government bonds. And so there you have it, introduction to gilts. If you enjoyed this video, please do subscribe to my channel and give it a like. And if you have any suggestions for other videos, I'd be more than happy to hear them. Take care everyone, and I'll see you all soon.